our webinar dedicated to UK property investments. This webinar, we're going to be covering two main cities that are always popular. It's London versus Manchester. Let me introduce the company and myself. My name is Katerina Arlova. I'm the director of the International Investment Department. I've been working in the real estate industry for about 8-9 years. And I used to work for Colliers International, for Knight Frank in London, for Sotheby's International Realty and Savills. Until finally, I'm the director at Intermark. I'm currently managing 25 brokers in 5 offices we have spread out between 5 different countries. And we still partner with Savills, who used to be our mother company for a period of 16 years, and 700 offices that Savills has throughout the world. We still rely partially on their expertise and build our own. We have been on the market for 30 years. This year we celebrate our jubilee. And of course, our expertise is one of the best on the market. And we work with international real estate in 3 separate directions. One of them is investment. I'm as a head of international investments, is mainly a specialist in this, in buy-to-let apartments, commercial real estate, such as retail, offices, industrial. Also, we do hotel investments and investments in renovation and development projects. Otherwise, our company has an immigration department that helps with residence permits, with obtaining a second citizenship, also other immigration visas, such as CB5 in the States, for example. Also, we work with what we call a lifestyle real estate. This is when you move to another country and buy a second home or buy a house for your children. We have a very good expertise both in Europe and in the States and in Asia, covering 70 countries with lifestyle properties. If we talk about investments, then my department is covering 3 main regions. One is Europe, where one of the countries is UK, which this webinar is dedicated to. Then we cover Southeast Asia, namely Thailand and Bali, 2 of the most popular locations for international investments. And then we cover Middle East. This is where one of our offices is, UAE, Oman, Bahrain, and we're probably going to be adding other locations as well, like Saudi Arabia. We're starting to receive requests about this country. And then we have an exclusive project in Brazil for diversification. But today is about UK property investment, and I wanted to introduce my colleague Cameron, who is the head of UK departments within our company. Cameron, but your mic is off. You should probably turn it on.
Excellent. Thank you for introducing me, Katrina. What I'd like to say for myself, I'm Cameron Tefel. I'm the Associate Director here at Intermark Global, and I've been helping clients scale UK portfolios for the last 7 years here in the UAE, as well as a few years in the UK as well. So if we'd like to continue with the next slide, that would be great.
I wanted to cover where we work in the UK. I know that a lot of companies, they only cover London and sometimes other cities such as Birmingham, Manchester, Liverpool. We have the greatest expertise in all of these locations, but we also work with another investment product, which is holiday lodges in holiday parks, and cover countryside locations for domestic tourism, such as Norfolk, Nottinghamshire, Scarborough, etc. We have had a collective experience of maybe 50 years in UK real estate among our team members. And of course, UK is one of the most popular locations for international investments, with the starting prices of just 155K and rental yields reaching 8%. One important thing to mention about UK, which we are often asked about, is whether investment in UK property gives you a residence permit or a right to any kind of visa. Unfortunately, it does not. But if you think about it, it's probably good for locals, since if the UK property, apart from the investment advantages, also gave you a visa, then prices would have skyrocketed and it wouldn't be affordable. Hence, why no immigration visas. Today's topic is comparing two main markets for real estate investments, London and Manchester. Obviously, London is the most popular location, but we wanted to give you another perspective on whether, or more like which city would be more suitable for your goals. Obviously, in London, the starting prices are significantly higher, almost 2.5 times, and due to higher expenses, both in taxes and in service charges, rental yields in London are twice as low as in Manchester. Another thing is capital appreciation. Manchester, according to Savills forecast for the next 5 years, gives a much higher prognosis for almost 12%, while London actually has a negative for the same period. We will cover in more length as to why it happens, but if we compare the cities, there's also point of universities and how they influence the tenant market, because mostly investors are looking for buy-to-let properties in both cities. And London and Manchester has the first and the second place of student retention in the UK. And since both cities have a really great community of students and great universities, it gives for any buy-to-let investor a very good rental yields and also a very high liquidity of rent. The void period in both cities is pretty much negligent. There's no void period. You can rent your property almost immediately. And of course, there's always a lack of new construction and there's a very high demand, which means that the prices are either stable or they're growing, which of course, stability is always one of the most important factors in any kind of real estate investments. If we cover UK as a location for investments, there's probably several things that we should mention. The first one is that UK is one of the first three largest economies in Europe, and also PwC, when they cover foreign investments, they've calculated that 30% of all foreign real estate investments goes into UK, approximately 30% goes into Germany, and then another 10% goes to France, which means that all other European countries combined only have a third of the total investment. And then basically what it means for any investor is that when you want to sell your real estate, the liquidity in the UK is unparalleled. Probably, on the same, on par with Germany, but then UK has a more transparent legal structure, which again we should probably cover. Let me go back to the presentation. I'm not sure why it disappeared, but here we are. British legal system is very clear for foreign investors, and it actually protects landlords more than tenants. So you wouldn't actually you probably have heard, like in Spain or other countries in Western Europe, how you have an occupied kind of tenants when a tenant moves in, and it's very hard to actually kick them out if they do not pay for their property. But then in the UK, the legislation protects the landlord, and if you have an unpaying tenant, if they even pay miss 1 or 2 payments, so do not pay only for 2 months, then you already can start the process of kicking them out, which takes a very short time compared to Europe. So as a landlord, UK is a more attractive country for investments. Another thing that is worth mentioning is that very few people actually think that UK is profitable tax-wise, because the taxes in Europe, well, and in the UK as well, are pretty high. However, many forget that there is a progressive tax rate, which means that if you have one or two apartments in London, or let's say in Manchester, your tax rate isn't going to be that high. And then there's ways to structure your investment in a way that will reduce the tax burden. Again, many people do not know about this, but you can buy UK real estate under any legal entity, even a foreign entity. So you don't have to open a local company. For example, if you own a Dubai company, you can just register it as a foreign legal entity in the UK and buy real estate on their company name. And if you give a shareholders loan, then you can reduce your tax base to almost zero, which means you will pay zero tax. And these are
sorry to interrupt you, Katrina. Can I add actually as well on the tax question? What essentially a lot of clients don't realize is essentially when scaling a portfolio and building that portfolio, essentially when you have a few properties or you're building and starting with just one or two, tax essentially should be essentially very low. However, it does affect slightly when you're building or may have a portfolio of 10 properties. So that's something to bear in mind for sure.
Yeah, of course, and we're going to have these tax ranges at the end of the webinar when we talk more about how to purchase real estate and the implications of that. But like I said, there are ways to structure your portfolio, and of course, we are experts in that as well, and we can always provide you with the context of tax specialists who can do a bit more unorthodox structuring that's is specific to your portfolio and your situation. Moving on, one of the more important aspects of any investments is the currency in which you invest. And pound sterling is one of the most popular currencies in the world, taking the fourth place after dollar, euro, and yen. And dollar investors, they still do have a bit of a discount when investing in pounds. Slightly growing since the beginning of 2023. Cameron, anything to add on the currency?
No. All good from my side. What I would say as well is if you look at the trends and for the last 15, 20 years, or even the 100 years, the UK has always been one of the largest and strongest economies, and our currency remains to be strong. So it's always good when looking at that for the real estate market.
Another good thing is that inflation is finally seems like it's been taken care of, more or less, since October. It's been gradually reducing and finally fell under 8%, and hopefully it will fall even more by the end of the year. And as we know, real estate is one of the few assets that protects you from inflation. So apart from rental yield, you always have part of capital appreciation, which normally protects you from the inflation parts. And here we are with the Savills price growth forecast. The latest one was updated in January 2023. As you can see, the forecast for 2023 isn't the greatest. We have actually a reduction in prices all over the UK. However, now is probably one of the best moments to invest, since I think most of these falling in prices actually already happened during the first several months. And then as we see, according to this forecast, we have prices growing again throughout to 2027. And the region where we wanted to focus your attention is Northwest, where Manchester, Liverpool, Nottingham, Leeds are, as one of the highest price growth forecasts is actually there. And this is also one of the regions that has shown um, stability in the previous crisis. Like, for example, in 2016, when Brexit was announced, London property as a more premium market, it was stagnating or even falling in prices, while, for example, Manchester or Birmingham, they were raising in prices 5 to 7% per annum, which actually shows not only foreign demand from investors, but also internal demand. Because Manchester, Birmingham, Liverpool are more affordable, and so they attract not only international investors but also local ones. And as a less premium market, they're more stable throughout the international crisis. This is the results of the last 12 months, how much the prices have grown by the UK region. We see the highest one in Wales, but I think it's a bit of an odd one, as Northwest, which is ranked second, actually shows consistent results of placing within the top 3 regions. And London, again, as a more premium market, is more how to say it's more susceptible to to any kind of economic crisis, and the market is a bit more stagnant whenever anything happens, which is of course natural since demand is shifting elsewhere. If we talk about particular cities, what we see is Nottingham, Manchester, which are the 2 main cities of Northwest, actually take the first and the second place respectively, with Birmingham, which is the second largest city in the UK, taking the third place. So if we compare London to Manchester, I would say that London is of course a bit more liquid markets, and it's better for a very long-term investment, let's say for 7, 10, 15 years, when your main goal is to preserve the capital, while Manchester is better for current rental yields and for a shorter strategy with investments, let's say 3 to 5 years. And moving on, actually to the projects. We have a very wide portfolio of projects in London and in Manchester both, and we've chosen the best ones for you for this webinar. But of course, if you have any specific requests for be it the price or be it the yield, we're always happy to find something tailored to you. Cameron, the word to you.
Yes, Liz, please. Excellent. So as Katrina said, what we actually take on as a provider, we tend to only work with a handful of developers, and really what we look for is a good track record and essentially something different with every developer or every provider that we work with. Now, moving on to this development, Fulton and Fifth, is actually by a developer called Regal London, which is one of our providers who are mainly, I'd say, in the outskirts of around London. Now, this development particularly is in Wembley. As you can see, the starting price is just under the £500,000 mark, with projected yields from anywhere from 3 to 5%, depending on what you'd like to do with that property. Depending on what kind of yield you'd achieve, is average around of London, with 5% I'd say being on the higher side and 3% being on the more conservative rate. There you have your sizes. As you can see, you get a lot more for your money in the outskirts. I think that's why a lot of the developers are targeting zones 3 or 4 or just outside the zones 1. The completion date, which will be in the first quarter of 2025. And typical London payment plan, which would be £2,500 on reservation, 10% on exchange, which typically is after 28 days, and the further 10% after a year, with 80% on completion. These are one-bedroom apartments with private balconies. I'd say with the developers we tend to work with in London, they really give international buyers that sort of feeling they may want or have in their country. So as you can see, there's amenities such as a 24-hour concierge to give you that extra bit of security, a swimming pool and spa, which is rarely seen in the UK. So it just kind of shows you what kind of premium development this is. And as you can see, the starting price is very affordable for London. If we could move on to the next slide, please. Some images on the development. I think this is very key as well, going into locations, and why I wanted to highlight this development in particular. This is actually literally, I'd say, 15 minutes out, as you can see, from Kensington, Chelsea, and areas where property prices go from millions upwards. So here you're around 10 or 15 minutes out. You have the Wembley Park Underground and Wembley Central, which will give you easy access to London via the Jubilee, the Metropolitan, the London Overground, the Bakerloo, and the National Rail. Essentially, every platform is available for you for traveling. And of course, from Wembley Stadium, you have the Chiltern Railways, which will also get you into Marylebone in 14 minutes. So very good connections. These are the types of developments that we target, in the sense of very good transport links and essentially getting you into central London for essentially a better price for investment.
Cameron, we do have questions in the chat, but probably
Sure.
the best time to take them would be at the end of the presentation, so we keep the line of...
I agree.
Okay. Normally, all apartments, they come with kitchen, yes, appliances, and the only thing that you have to buy is the furniture. And then the furniture is normally provided by the developers in form of furniture packs, which are worth anywhere between 4 and like 7 to 10,000 pounds. Okay. Next one.
So moving on, actually, this is a favorite of mine, and this is complete by Berkeley Homes, who are one of the largest providers in London as a developer, with over 60 projects in and around London. Now, with Chelsea Creek, what they actually have done, you may have seen it on the marketplace for quite a while, but what they actually have done, and what Berkeley tend to do, is build communities rather than a single-handed development. So over time, they have different phases, and what you have actually, and it has been so popular because of the location being in Chelsea, prime central London, Chelsea Creek. Now, it's starting at around £810,000, and it does range. It does go quite higher, depending on what you're looking for. The yields, as there are complete, we can go on factual numbers, so that they're yielding at 3 to 4% per annum. There's the sizes, which are actually good sizes, starting at 57 to 89 square meters between the 1 and 2 bedrooms. It is a complete development, and as I said, I believe they're actually in the final phases. So there's a good chance of getting a good unit at the moment, good availability. As you can see, some of the furnishing inside. All developments come with good amenities, swimming pools and concierges and things, as I mentioned, which seem to be in other countries and are more so that premium sort of vibe. The location is phenomenal, being 4 minutes away from the Imperial Wharf Station. You have the Fulham Broadway, which is a 14-minute walk. Knightsbridge being a 12 to 15 minutes drive. This is a key part of London, and genuinely, I think it's excellent for both rental purposes as well as end users.
Right, moving to the next project.
Excellent. A personal favorite of mine, Lions Investment, as well as the Heaton Group, a joint project for Berkeley Square, which is just in the media city of Manchester. The reason it's actually popular is because a lot of the financial stock exchange companies coming over from London have been targeting the media city. Secondly, I would say that the Manchester has the airport expansion as well as the HS2 train, which has been anticipated. Although moving deadlines for date, it's still due to be complete. Now, with Berkeley Square, actually, what I'd say is it's more of an affordable development, and it's very good for new investors as well as ongoing investors who are looking at adding to their portfolio. Now, you have an excellent starting price at around £213,000. You have projected yields of 5%, which I think is personally being conservative. Manchester yields have been sought and known to be going up to 7%, 8% upwards. You have good sizes, of course, being on a little bit of the outskirts of the city centre. You will get larger units. And of course, the completion date will be in 2026. So as I said, again, the location is 2 minutes by tram to the media city. It will take you literally directly to that city centre. And you have Manchester City Centre, which is the tram will take you to by 14 minutes. So it's situated in a very good place. You have a Panoma Island, which is literally opposite development, which is having a huge regeneration with over £1 billion in as well. So that should add some value to the development itself.
Yeah, I would probably add that it's located right on the river Irwell, and the whole first line of the river, starting from, actually, I can show you with the, yeah, from here upwards, most of the river, it's either has been developed or is under development, which means that once it's finished, the prices in this area specifically will go up. And then another thing that Cameron has mentioned, it's right between two city centres, because one is the Manchester city centre, yeah, where the M1 postcode is, and then another sort of city centre is Media City UK, where you have the headquarters for BBC, for ITV, and it's a huge media hub where you have a lot of potential tenants. And then for tenants who work in both areas, it's very convenient to go around, which makes, again, this location is it's probably one of the best ones to invest in Manchester at the moment. And these are the renders, which should go up in a second. Right, next project.
Excellent. So this development actually is situated city centre Manchester. So as you can see, the prices change slightly from the starting price. You have similar sorts of yields, but it just kind of changes and gives you that feel for maybe wanting something a bit more city centre, a bit more premium, and of course, with boasting that M1 postcode, which, postcodes, of course, mean something massively in the UK. Now, with this development, it's situated perfectly, I'd say. It's basically in the close by to the northern quarter, where essentially is kind of like a mini Shoreditch, I'd say, comparing to London. It's basically what's happening in Manchester. There's bars, restaurants, and it's a really quirky part of town. Also, images inside. All apartments that we have shown you are fully fitted with appliances.
And then the next project.
Just to mention, actually, whilst we have Manchester and comparing the two at the moment, I think a key thing to touch base on is that Manchester's seeing similar sorts of trends that London did maybe 10 or 15 years ago. And yes, while London is one of the most stable markets worldwide, Manchester seeing them similar sorts of trends where you could see prices just a comparable, where 250s, 260,000 for prime city centre in one of the largest cities in the UK. Essentially, these prices will virtually follow the same trends that London did and reach as the stage they are at now. So with One Port Street, it's actually one of my favorite developments. It's also situated in the Northern Quarter. It's boasting the M1 postcode, and it's a premium development by Select Group, who have kind of dominated Manchester with the other developments, which may be 360 and Blade. It's boasting over 477 luxury apartments, and it has a completion date of 2025 in the fourth quarter. It's situated at a very good price point for the moment, and definitely will be, I'd say, if not one of the most premium developments in Manchester. More CGIs.
And the location.
Yep, back to the location. Also, what I would say to mention is, if you can see just on towards north of the actual location, you have an area called Ancoats. Now, Ancoats has been fully regenerated by Manchester, and there was a big regenerational project which happened that side. Now, with this location, it's perfect anyway, but it's going to be good for growth that and added value that regeneration's happening in surrounding areas.
Right. I think we actually missed one of the projects in London. Let me go back to this one because we had 3 for London, 3 for Manchester. This one is the Hayden at London Square Mile. Cameron, if you could.
Yes, I know it actually. I think the key thing to point out, and as I mentioned earlier, is that these London developers are seeing that clients want more so something which is maybe just on the outskirts, and they're going to just get a lot more for their money. Now, I'm actually from London myself, and being situated not far from Aldgate East, I know the location really well. And I'd say it's literally 10 or 15 minutes into central London via drive, and literally maybe 10 minutes or so, 8 minutes or so via train from maybe Oxford Street from Aldgate. So this location is fantastic. The pricing is affordable for London from where it's situated. And as I said, you have the Aldgate Underground Station as a 2-minute walk, Liverpool Street Station, 10 minutes. So you can see this is really good for location, and maybe really good for something for a short stay, as well as a long-term premium sort of tenant.
Okay, and showing the renders again. And I think like we said previously, we work with the most reputable developers around the UK, and we can always choose a right project for you, be it investments or maybe combining a second home with investments, whatever your goals, be it long-term capital preservation or short-term higher rental yields and capital appreciation in the moment. If you go to the process of investing in the UK, I will probably stop on a few moments that are important. The first one is the process of buying a property. It's very convenient since you do not need to come to the UK or open a local bank account. It's all done through the UK solicitors who have a professional license that you can check on the government websites, and they also have a professional indemnity insurance. All the transactions are done through what is called a client account of the UK firm, which is a kind of an escrow used to keep your money until the exchange of contracts has happened. There's terms, which is the exchange of contracts. It's where you enter a sale and purchase transaction, and after that point it becomes irrevocable. And then there's a point of completion where you have paid the 100% of all the monies owed, and then the property construction has been completed. After that, the documents, they will go for registration at HM Land Registry. What's important is that most developers give you a certain timeline in which you need to exchange the contracts with the help of your solicitors. It's normally 28 days, either after your reservation has been signed or after the contracts were issued. And unless you actually make it work within that kind of time, you may lose your reservation deposits, which is anywhere between £2,000 and £5,000. So it's important to keep up with the solicitors and provide all the documents that are needed. And another important thing to mention is the speed with which Land Registry is registering your property. Right now, this process takes up to 15 months, which is, yes, a bit long. However, you may use your property as you wish. You can rent it out, live there yourself, right after the point of completion, because the solicitors will confirm to anyone interested that you are a rightful owner of the property. Another thing to mention is the list of required documents, as in the UK it's pretty comprehensive. Apart from passports and proof of address, which is a utility bill or bank statements issued within the last 3 months, you will also have to provide the confirmation for your source of funds, which you do not actually need in many other countries, like in Middle East or Southeast Asia. No one will require this of you. But here, you have to prove where your funds are coming from. You have to provide all the required documents, such as payment slips, sale and purchase agreements, dividend distribution documents, and you also have to provide the bank statements showing how this sum has originated and how it was moving from one bank account to another until it finally reached the account from which you're going to make the transfer to the UK solicitor firm that you're working with. Moving on to another important part, taxes. The two main taxes that we need to mention when talking about real estate is stamp duty, land tax, and income tax. Stamp duty is the property tax that you pay at point of buying the property. It is paid at completion, not at exchange of contracts. Like for example, in Dubai, you have to pay the 4% when you actually sign an SPA agreement. Here, you have to pay when the property is completed. And the tax rate is progressive, and it depends on two factors. First, is it your first home that you own worldwide? And then the second point is whether you're a UK resident or not. If you're a non-UK resident, it will be automatically plus 2% to each of the rates that is mentioned on this slide. And then if you buy an additional home, it's plus 3%, which you can see. So when you buy a fairly expensive property, such as, for example, London properties, you would pay more stamp duty. And this is one of the reasons why your rental yield in London is slightly lower. Then the second tax is income tax. It's progressive. Some countries, some citizens of specific countries, they have a right to personal allowance. It will depend on the tax treaty with the specific country. With UE, there's unfortunately no personal allowance, so the base rate is 20%. And then with any country, you first have to pay the tax where your asset is located. In this case, it's UK. And then if you have to pay something in your country of tax residency, according to the tax treaty, then you just have to pay the difference. If the tax in tax residency country is higher than in the UK, which is probably not going to happen, let's face it. But then there's ways to structure your investment in a way where your income tax, or more like corporate tax, is going to be very low. For example, if you have a Dubai company, or pretty much a company in any kind of country of Middle East, you can buy your property directly on this company. You can give a shareholders loan to this company, for example, with the interest rate of 5 to 8%. And then your tax base will be reduced by the interest that your company is paying to yourself as a shareholder. And because of that, the tax base is going to be pretty much zero, which means that you're not going to be paying any tax. Another tax that is not mentioned on here is the capital gains tax that you will need to pay once you exit the investments. And if it was your primary residence in the UK, you wouldn't need to pay it. But then if it was a rented house, then you either pay 18 or 28%, depending on which base rate of income tax you were falling into this year. If it was basic or below, then you would pay 18%. If it was a higher rate or above, then you would pay 28% on the profits that you have made with your investments. I think that about covers it. Thank you very much for your time. And we will take the questions now. One of the clients is asking, what are the rental trends and what's the best time for buying for rental portfolio? I will take that, I think, and then Cameron, if you have anything to add. Sure. What happens is that in the UK, there's a lot of demand for property, like generally speaking. And right now, when the base rates of pretty much all the banks is pretty high, many investors, they think that getting a mortgage is too expensive for them. And when it's too expensive to get a mortgage, they still need to live somewhere. So what they're doing, they're renting instead. So whenever property prices are stagnating due to mortgage prices, mortgage interest rates rising, what happens is that rental yields are normally rising. And what we have seen with Savills forecasts is that the rental rates in London have actually gotten up by 17%. And then they're going to continue rising as long as the base rates of the England Bank is as high as it is right now. And as long as the inflation rate is pretty high, the base rate is going to stay high to reduce that inflation rate. So we can fairly surely say that the rental prices are going to be rising during this time. So if you're investing for rental yields, it's a very good time to invest for sure.
Yeah, I think you answered that perfectly, Katrina. What I would say is, and what I would add on is the final bit of the question, which was, when is the right time to buy? Personally, I think it's always the right time to buy, especially when buying in bricks and mortar. It's one of the most stable, safest asset classes in the world. And genuinely, some people, for instance, whether it be the UAE, whether it be anywhere worldwide, they keep in their mind that they anticipate there may be drops, there may be these things sorts in the market. However, in reality, now is always the best time to buy, whether it be now. The main thing is to get involved.
Yeah, of course. Another thing is that in the UK, you buy when you buy off plan, you only pay a certain percentage of the property value, be it 10% in London or 25-30% in Manchester and other cities, which means that according to this table, you will see the capital appreciation that is starting to come back on the market, the price growth according to Savills forecasts. And then, of course, the property prices, they have to grow, because the construction prices have risen dramatically. The costs of materials have risen, and the developers, they need to keep their profit margin, otherwise they're going to go out of business. So it's pretty much impossible to reduce the prices as they are now. So you will definitely see capital growth, and you can sure see high rental yields right now.
I think that goes back on as well what you mentioned earlier, touching base on the undersupply for homes in the UK. Now, unfortunately, it's an issue all around the UK, and we do get this question a lot. Actually, some people do asking how come there are many developments coming up in the north. The reason being is, well, there is a huge undersupply throughout the UK for properties. So essentially, we need to build more than we're actually building now, and we're not building enough. So more property. Obviously, there's a supply and demand, so we need to fulfill that as well in the UK.
Yeah, and we are a very analytics-focused agency. So we regularly monitor Deloitte reports. They do a crane survey reports annually, and the lack of pipeline in most UK cities is staggering, honestly. There's like just not enough to satisfy the demand.
Right.
All right. I think it was very informative. Thank you for taking the time to dedicate it to this webinar. If you have any other questions, we will be happy to have a individual consultation with you. Cameron and his team are always present. So again, thank you and have a great evening and a great weekend, which is coming
Excellent.
ahead.
Thank you, everybody, for joining. It's been a pleasure. Hopefully, we will have some more insightful webinars coming up soon. But in the meantime, as Katrina said, anybody who's wants to get in contact, feel free to reach out and ask any questions you may have. And it's been a pleasure from our side.
Definitely. Thank you and
Excellent.
goodbye.
Bye-bye.